Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. Tonight we're going to go over all of the trading adjustments that we made here on Tuesday, September 2nd. So hopefully you guys had a nice long Labor Day weekend and holiday for those of you who are in the US, that is. Just another reminder, we sent out just this morning, just to our members, the webinar that we're going to be doing next Monday and next Tuesday. The same session back to back, so you don't have to sign up for both. But currently, after just sending it out to members, we only have 4 spots available for the Monday session, and for the Tuesday session, we have 6 spots left. So again, that's only 4 spots available for the Monday session and only 6 left for the Tuesday session. I encourage you guys to go ahead and sign up for this webinar because we are going to be talking about a lot of the stuff that we're talking about actually tonight. In tonight's video is going to be kind of like a precursor to the webinar, talking about trade adjustments and how to adjust losing trades and how to cut your losses and even keep the possibility open for some wins. So I definitely think it's going to be sold out here in the next day or so. So go ahead and get over there, get those seats reserved so you can save your seat in that webinar. All right, so today, like I said, we're going to go over all the trades that we made. We only made 2 trades today, and they were both adjustment trades. So both of those adjustment trades are down here in the bottom section, which can be found on the membership side of the homepage for Option Alpha. The first one I want to go over is Yahoo. Yahoo's really interesting because this is now our second adjustment that we've made to the Yahoo trade. And I want to walk through not only the reason why we made the adjustment, but now what our profit loss diagram looks like, adding this adjustment into the mix here. So the actual logistics of what we did is we went ahead and sold an additional put spread below the market with Yahoo. So Yahoo continued to trade much higher today, kind of continued to break out higher. So what we did is sold a 38-37 credit put spread. So we sold the 38s, bought the 37 strike, took in a credit of 38 cents. And you'll notice that we did about the same number of contracts that we've done before in Yahoo for those of you who are following along. So with Yahoo, let me go to the chart first here so you guys can see where the stock is going. So now the stock has definitely gone a little bit parabolic. I think it could be definitely in an area where it could potentially move down before we get to expiration, but I don't want to just assume that that's going to happen. Implied volatility still remains very high at the 72nd percentile in Yahoo, so it's still very, very high implied volatility. And what we did is we came back in here today and sold a put spread with a short strike right at 38. So that's exactly where it is on the chart, so you can kind of visualize it. Now we go over here to the Analyze tab, and this is actually what our position looked like before we made that adjustment. So we had originally had this call side trade on Yahoo, so we originally had the 38-39 call spread, and now that Yahoo continued to move up, we went ahead and added just last week the put side to our trade. So we sold the put side of the trade that created an iron condor in Yahoo, helped increase our premium, reduce our overall max loss, but now Yahoo's continued to move outside of that range above our short strikes on the top side. Now the key here is that we're not going to touch this top side trade, right? We're not going to move this side of the trade at all. And that's what a lot of people try to do, is they try to move the side that the market's moving against. And that's the wrong way to go about it. What you want to do is you want to focus your attention on either A, moving up this put side closer, so taking the profit on this trade because the market's moving higher, moving it closer, or just adding another position somewhere in here to, again, take in more premium. So what we actually did is, again, we added the 38-37 put spread, so I'm going to just put those up here on the chart now. So now with that 38-37 put spread, it looks something like this. It's kind of like a hybrid between a butterfly up here, because we have short strikes around 38, and a credit put spread down here, because we still haven't gotten rid of our original credit put spread, even though it's worth very, very little. Now at this point, what we stand to lose in Yahoo, should it continue to go higher, is only $36. So with this adjustment, we've basically capped our max loss to only $36, and we have that an opportunity to both make money. We can make money here around 38 if Yahoo continues to move a little bit lower, or if Yahoo just keeps moving lower, we actually really start to lose money around 35. So we've got a really, really nice window of opportunity, and I'll go back to the charts here. We've got a nice window of opportunity to either A, lose about $36 only, or make some money if Yahoo can kind of fall somewhere in this 38 range, which actually might end up happening. Yahoo might, kind of pop here at the beginning of expiration or halfway through expiration, and then maybe come back down and settle into 38. But right now our max risk is only below about 35. So that's the reason that we just kind of added that side to the trade. We could easily close out of that put spread below the market. It's only trading for about 8 cents right now. So that would increase our max loss just a little bit because we potentially want to grab that 8-cent premium. But you can see here that this adjustment really took our max loss from somewhere around $188. That's what we would have lost had we done nothing and Yahoo continues higher. Now our max loss is only going to be around 36 as long as Yahoo stays above 35. So very, very interesting adjustment and a very, very different type of adjustment than you probably normally see. But this is something that we can obviously do. We can add this position. If Yahoo continues higher, then what we'll do is probably get rid of that put spread that's well below the market as it starts to decay in value. I'd like to buy it back somewhere around 2 to 3 cents, somewhere in there. If we can do that, then I'd be okay actually getting rid of it. All right, so the other adjustment that we made is to another iron condor, and this is in XLU. So this one actually worked out pretty well today because XLU rallied early in the day. That allowed us to get rid of this put or buy back the put that we were short on the bottom side of our iron condor. And then at the end of the day, XLU continued to move lower. So this whole thing is doing really, really well now that we've made this adjustment. I'll go to the chart here of XLU first so you can see exactly what it looked like during the day. And so you can see that as the market opened up, it actually rallied up to around 43.50, 43.40 or so, but actually closed on the day much lower. So it fell away from where the highs are on the day and actually closed much, much lower. So that really helped our position because our short strike on the top side is right at 43. So on the top side, our short strike is right here at 43. The position just went into the money. So what we did today is we just bought back one side of that iron condor. So down here below, what you'll notice is that we did have the 43.44 on the top side and the 39.38 on the bottom side. What we did is we bought back our short 39 puts because they were basically worthless, right? So we paid about 3 cents for them. They had decayed in value practically the entire way. And what we did is we decided to actually keep these long puts at 38 because they're only worth about $2 to $3 as well. But at this point, it might cost us almost double in commission to get rid of these. And they help to protect in case of a huge, huge fall in XLU for some reason. So by keeping those on, they're very, very small dollar amount. And I always tell people that if you do this where you leg out of an iron condor, make sure that you understand how much you stand to lose on that long put that you're keeping. Because sometimes if you leg out and that long put's still worth $50 or $75, you might actually end up adding to your risk. In this case, they're only worth about $2 a piece, $3 a piece, so they're really not worth a lot of money, but they do serve as very, very good downside protection. You can see over here on the left-hand side of the profit loss diagram that they serve as really great downside protection should XLU fall. But again, just like Yahoo, what we now have is ironically enough, a $36 loss so long as XLU stays below 43. So as long as it continues to stay below 43, we have a very, very marginal loss. If it does continue to move higher, which it definitely could do that, but it looks very, very toppy to me, and all the technicals are really saying that's kind of getting overextended and definitely coming into a massive area of overhead resistance up here. A lot of selling pressure, and it's going to be tough to get through there. But if it does, then what we could do is we could just go ahead and sell a put much closer to XLU. So somewhere around 42 or 43 or 41, we can go ahead and just sell a regular naked put. Again, adding more premium to the strategy, widening out that break-even point because of those credit spreads, or because of that credit that we take in. So as always, hope you guys really enjoy these videos. This is just a small taste of what we're going to go over in the group coaching webinar. Like I said, that's going to be next week on Monday and Tuesday. It's the exact same session. You do not have to sign up for both. We're talking about the same information, just probably different questions with different people for those sessions. If you guys have any questions about the trades we made today, let me know in the comment box right below, and happy trading.